When analyzing any equity crowdfunding deal, before diving into the product or team, investors should have a thorough understanding of the type of business that they are investing in. Today, we're going to be discussing some very important topics about business types, such as the differences between a high-growth startup or a lifestyle business, capital efficient versus capital-intensive businesses and what the differences are, how business structure, such as LLC versus corporations, can impact your taxes, and then other common business terminology, such as unicorns, zombies, and business models such as B2B and B2C. Thank you again for tuning in. This is Brian, founder of CrowdWise. Let's get into it. Today's lesson, kicking off Module 2, we'll be talking about types of businesses that you're going to see in equity crowdfunding. As a reminder, you're part of the Level 2 Intermediate courses in Module 2, where we're looking at businesses, terms, and offerings. If you haven't already, head over to academy.crowdwise.org and create your free account for the best learning experience. We've discussed it in the past, but let's recap quickly. What is a startup? There's many definitions out there, but the one that we like the best is that a startup is a company working to solve a problem where the solution is not obvious and success is not guaranteed. Now, obviously, this could apply to a broad spectrum of companies, but we specifically apply this when considering businesses in the private markets and especially early stage. Also, as we've discussed in the past, a startup goes through a life cycle when raising funds. As shown here, it ranges from the friends and family round to seed, Series A, Series B, and then onward until public. Thus, it's just important to keep in mind that when you're looking at businesses, they will range in terms of their product maturity and the amount of money and valuations that they're raising at. According to famed angel investor and entrepreneur David Rose, there are two primary types of deliberate exit strategies. We say two-ish because an IPO is also sometimes quoted as an exit strategy. However, as David mentions, he doesn't believe it is a deliberate exit strategy because they are so rare in occurrence. From his book Angel Investing, David Rose goes on to say that the question of a deliberate exit strategy for a startup boils down to two possibilities: the sale of the company as a high-growth business to another company or to a major investment organization, or its sale to the company's founder, who might be seeking a lifestyle-supporting, income-generating business. The primary question for crowdfund investors is, which type of exit should you be targeting in your investments? So, looking at this in another way, we have the outside investment capital, which is your investment in a business. As David mentions, the first type of sale is a sale to the founder, which provides an exit to investors. The second type of sale would be a sale to a buyer, which could be either a strategic buyer, buying it due to synergistic effects in their portfolio of other businesses that they hold, or a purely financial buyer. And last but not least, that 1 in 1,000 shot, according to David Rose, the IPO or initial public offering, which is extremely rare. In building each of these types of businesses, the business will need to focus on different areas. For example, when looking to build a business to sell to a founder, the focus will be on profitability, avoiding excess debt, and having sustainable growth. Contrast this with looking to sell to a buyer. The focus here will be on maximizing growth, and also valuations will typically be looked at in terms of future potential revenues and profits, not current. So for the crowdfunding investor who's looking to invest primarily for financial reasons, you should really be focusing on these last two. That isn't to say that you won't want to invest in some of the other Main Street companies that are providing more of a lifestyle business to their founder and employees. What do we mean by a lifestyle business? Let's go on to define that now. We'll call it the growth spectrum of startups. First, there's a lifestyle business. Here, goals are to provide comfortable income for the founders and employees. The growth strategy is typically a bootstrapped one, focusing on organic growth, taking in limited funding when needed, and focusing more on profitability versus extreme growth. Thus, the growth potential of lifestyle businesses is limited. They don't intentionally pursue an acquisition or an IPO, or at least not as aggressively as a high-growth startup. Examples of this could be a mom-and-pop restaurant chain, perhaps a microbrewery down the street, but also, one I want to mention here is MailChimp. The reason is that MailChimp has had no external investors or outside VC. It's been 18 years in the making, but as of 2017 posted $525 million in revenue. It was also Inc.'s Company of the Year in 2017. This goes on to show that while it doesn't meet the definition of a, quote, high-growth startup, lifestyle businesses can still go on to have much greater than just a mediocre success. Now, let's take a look at a high-growth startup. Goals here are to pursue maximum growth, looking to become the acquisition target of another business or later-stage investors. The growth strategy, thus, is heavily financed, taking on a lot of debt or outside capital, and it may not be profitable for a long time. Think of the example of Uber, a public company now in mid-2019 with over a $65 billion market cap, and yet they're still losing $1 billion per quarter. The growth potential of high-growth startups is very high, as the name implies. They're aiming for massive exits via large acquisitions or potential IPOs. In terms of statistics, again taken from David Rose's book Angel Investing, he says that roughly 41% of angel-backed companies are acquired or bought in some fashion, while roughly 0.1% or 0.2%, depending on some other data we found, of angel companies will IPO. Examples of some of the high-growth startup companies are any of the big names that you can think of today, such as Facebook, Alibaba, and many more. Obviously, they're not startups anymore, but before they became massive successes, they fit this profile. It's very important to ask with any business that you're looking at, where does this business fit on the spectrum? Is it more of a lifestyle business, or perhaps more of a high-growth startup? It's important to recognize that a business will not fall 100% on one side or the other. That's why we call it a spectrum, where often it's a blend of the two, and determining that is important. Ask yourself, is this looking to provide more of a comfortable lifestyle for the founders and employees? Or is this a moonshot, pouring in all the rocket fuel of outside capital and trying to get enough velocity to escape the gravity of the Earth, or in this case, to reach profitability? Now, as you can expect with a rocket analogy, many high-growth startups are going to come crashing back down to Earth when they can't make it. However, as we've shown in the past, reaching for these potential home runs is how many early-stage investors and venture capital firms make all their returns. Going back to David Rose's book Angel Investing, we're going to summarize the likelihood of exits as David mentions from his own experiences. As you can see, more than 50% are expected to go out of business. He believes that roughly 20% sell to a larger company, 15% exit via acqui-hire, 7% end up being that walking dead, which means that investors can't get their money out. And then it goes on to be smaller and smaller until, as you can see, the smallest slice of the pie and barely even visible, roughly 0.1% or 1 in 1,000 businesses will IPO. Next, we're going to move on to some common business terminology that you'll see when screening equity crowdfunding deals online. First is the notion of capital efficiency. Capital efficiency is essentially the amount of assets needed to produce a dollar of sales. So, if you look at capital efficient businesses, they will typically have limited capital required in order to test that their need is an actual need that customers are willing to pay for. Thus, they can also typically pivot and iterate much easier on their product. They require less capital to scale in general, and they will have fewer tangible assets, since they might be able to develop a software product with just a few laptops and won't really be investing in expensive property or equipment. Some of this can be a downside, as their business may be less defensible, especially early on, as it's much easier for competitors to also mimic or replicate their success. An example of a type of capital-efficient business is software as a service. Think of Stripe, Dropbox, and some of the other software services that are now massively successful. Remember, capital-efficient businesses may have better chances of pivoting and may be able to demonstrate a minimum viable product, MVP, or product market fit, PMF, with less overall capital. Thus, some angel investors and venture capital firms choose to invest in only capital-efficient businesses, since they believe that the value of each of their invested dollars can go a longer way. In contrast to a capital-efficient business is a capital-intensive business. These usually require more capital in order to reach each next milestone. They may require larger capital investments before a prototype or minimum viable product can be demonstrated. They may require more capital to scale. Think of needing to set up for manufacturing of complex hardware, or perhaps having much higher marketing costs and customer acquisition costs, or required infrastructure. Thus, they typically have more tangible assets. However, some risks are, first, dilution. Since capital intensive, by definition, will require more capital, If they haven't reached profitability, they may be required to raise more funds more often. Thus, early investors have a risk of getting more diluted in a capital-intensive business. Also, it's much harder to pivot, and there's a much higher risk of failure with significant investment. However, some of these things are also pros, because all of these things make it much harder for competition to come in and upset a capital-intensive business. So, some examples of capital-intensive businesses are, for example, SpaceX. Think of a spaceflight business developing complex hardware. Few people know this, but SpaceX was actually on the brink of failure. When developing their Falcon 1 rocket, the first 3 launches failed, and they were down to their 4th, and as Elon Musk says, their final rocket that they had money for. Fortunately, that 4th rocket launch was a success, and the rest is history so far for SpaceX, but this goes to show that a capital-intensive business has a lot more risk riding on initial investments, and it's much harder to change course if it doesn't work out. Also, other examples of capital-intensive businesses may be insurance companies, pharmaceutical companies that make new drugs requiring rigorous FDA approvals, and many more. Next, we're going to talk about the 2 different types of business entities that you'll encounter on equity crowdfunding portals: an LLC, limited liability company, versus corporations. Understand that the type of business you invest in can impact your taxes, even if you're only investing as little as $10 in a startup. Also, just a disclaimer that I'm not a tax professional. This is for informational purposes only. Every investor's situation is unique, so nothing here should be construed as personal, legal, tax, or investment advice. Always consult with your own professional tax, legal, or investment advisor. All that being said, let's now get into the differences of business entity types. There's the C corporation, the limited liability company, LLC, which can be taxed as either a corporation or taxed as a partnership, and then B Corps, SCorps, and others that we'll mention briefly. Remember, everyone's tax situation is unique. We're providing this information to assist investors with common things to look out for and to be able to ask intelligent questions and discuss with your own tax advisor. First, let's take a look at the breakdown of regulation crowdfunding business entities to date. From May 2016 to December 2018, roughly 1/3 of all business entities through Reg CF were LLCs, while the other 2/3 were C corporations. Now, what this doesn't show is what % of those LLCs were taxed as partnerships versus corporations. However, you can see that it's not an insignificant amount of LLCs that are out there that can potentially impact your taxes. Let's talk about C corporations. C corporations are set up for governance, existing and thorough case law, and are typically the best for future acquisition and selling. As such, venture capital firms typically require or will strongly encourage their founders to convert to a C corporation if they aren't already. In terms of tax forms for C corporations, you may receive a 1099 if dividends were paid. However, paying dividends is uncommon for early-stage companies, so usually there's no tax forms for C corporation investors. In terms of tax considerations, there are some important things to remember. First, there's no pass-through taxes. This is not like an LLC, so typically there will be no annual tax filing requirement, unless there was a loss or a sale. Also, you may qualify for Qualified Small Business Stock QSBS, which would allow a Section 1202 deduction, which is an up to 100% exemption on your QSBS gains, up to a limit of $10 million or 10x the cost basis if you held the investment for more than 5 years and it meets other criteria. It may also qualify for Section 1045, which allows for a deferral on QSBS gains if reinvested within 60 days per Section 1045. Also, it may qualify as a small business corporation, an SBC, which allows a Section 1244 exemption, which allows you to write off qualifying SBC losses as ordinary losses instead of capital losses, potentially reducing your tax burden. Remember, always refer to the latest Internal Revenue Code sections on the IRS website and talk with your personal tax advisor about if these exemptions apply to you. Let's now talk about a limited liability company. Offerings will usually be in membership units instead of shares of common or preferred stock. LLCs on Reg CF portals will also elect to be taxed in one of 2 ways. First, the LLC may be taxed as a partnership. When taxed as a partnership, LLCs are pass-through entities. This means that gains and losses pass through to individuals' tax returns. Thus, when it comes tax time, investors in LLCs taxed as partnerships may receive a Schedule K-1. That can trigger gains or losses on your personal taxes, even if you never actually received anything from the business throughout the year. Furthermore, Schedule K-1s can cause headaches, especially if they're late, since they can hold up your personal tax filing. A founder of a startup has a lot of things to do on their priority list, and so sometimes Schedule K-1s can fall to the bottom. Lastly, it may require you to file state income tax returns in multiple states, or for non-US citizens to owe US taxes. Remember, each of these things is only a maybe, so consult with your personal tax advisor for your situation. So, it may be beneficial for investors who are looking to avoid double taxation, looking to write off operational losses during the year, but remember, you still aren't going to be able to control this as a crowdfunding investor, or for investors looking to obtain better outcomes if the business is sold when held for fewer than 5 years or if acquired for assets. Again, just remember that these are still outside of your control as an investor. The second type of LLC is one that's taxed as a corporation. An LLC taxed as a corporation will have all the same pros and cons as the C corporation that we mentioned on the previous slide. However, while you may not receive a Schedule K-1, you also may not be eligible for the corporation deductions mentioned on the previous slide, such as QSBS and SBC. We'll mention briefly SCorps and B Corps, since you may also see or hear them. First, a benefit corporation or a B Corp is one whose status only affects requirements of corporate purpose, accountability, and transparency. B Corps still must elect to be taxed as either a C Corp or an S Corp. And on regulation crowdfunding portals, as we'll go to show, you'll typically only see C Corps. So why don't you see more S Corps on crowdfunding portals? That's because, again, while they're pass-through entities, similar to an LLC taxed as a partnership, it's because the nature of regulations that are imposed on S Corps greatly limits their ability to raise using equity crowdfunding. Some of these restrictions include requiring 100 or fewer shareholders, only allowing US citizens or residents to invest, and only allowing natural humans, meaning VCs or other entities can't invest. Thus, you likely won't see many S Corps on crowdfunding portals. If you do own equity in an S Corp, though, expect to receive a Schedule K-1, similar to that LLC taxed as a partnership. Let's talk about 3 terms you may hear to describe a business when talking about business returns. They are a unicorn, a decacorn, and a zombie. 2 of these are good, and 1 of these are bad. Can you tell which is which? You've probably heard of a unicorn. Essentially, all that a unicorn really means is that it's a business with over a $1 billion valuation. Now, this doesn't tell you when that investor or venture capital firm may have invested, so it doesn't really tell you what the potential returns were for a given investor. However, to be able to reach a $1 billion valuation, that business has had some level of success. Now, a decacorn, as you might guess, is similar to a unicorn, only it's a business with over a $10 billion valuation. Lastly, as we've mentioned in the past, there's a type of business called zombie, or living dead. It's a business that has not failed, so it's not bankrupt or hasn't been dissolved, but it's also not growing enough to attract potential buyers or to provide an exit for investors. Even though the business may not be a failure, it is a failure for investors. Last but not least, let's talk about some business model terminology, B2B and B2C. The type of business model, whether it's B2B or B2C, will require different metrics for target customers, marketing and sales, and product development. First, the B2B, or business to business. This will typically have high touch, higher costs, multiple products, but fewer customers. Contrast this with a B2C business model, where you'll typically see lower touch, lower cost, single products to start out, and many customers. There's also infinite combinations of these, B2B2B, B2B2C, B2all and B2both, and many more. If you get a good grasp on the 2 basics of B2B and B2C, you can translate that meaning to the others. Andreessen Horowitz shows a great graph that shows how sales and marketing compares for both a B2B and B2C business. Think of a consumer-focused business, such as toothpaste sales, whereas an enterprise-focused business, or B2B, may be something like jet engines. These are 2 very different businesses, and they contrast the 2 by looking at the focus and costs of sales versus marketing. Think of the tube of toothpaste. You're not going to have a salesman standing in the aisle trying to sell you a tube of toothpaste. Thus, sales costs are typically much lower, but they'll be spending much more on marketing. On the other end of the spectrum, think of a jet engine. Here, instead of many customers, you have only a few big customers. You know exactly who your customers need to be. You'll probably be spending much less on general marketing, but what you probably will do is be assigning individual salespeople to go and sell into those businesses and support those accounts. This is just an example of how B2B and B2C businesses differ. Alright, we've covered a lot today, so let's do a quick recap. We've talked about the growth spectrum of startups, ranging from high-growth startup to lifestyle business, and which one investors should be targeting. We've talked about business types and terminology, such as capital efficient versus capital intensive, LLCs versus corporations, unicorns, decacorns, zombies, and B2B and B2C. Now that you have a good idea of the types of businesses that raise on Reg CF portals, it's important to move on to the what in Reg CF, which are the offering types and deal terms. Next lesson, we're going to talk about types of Reg CF offerings, also called financial securities. Is it equity, debt, a safe, a convertible note? There's a fire hose of new information for investors coming from the public markets, so we'll be breaking it all down for you. We'll be talking about deal terms, including common pitfalls and what to watch out for in regulation crowdfunding deals. And lastly, how to know which type of security to invest in. Thank you again for watching this lesson, and we'll see you back here for lesson 2.